Welcome to Iron Financial, where we forge stronger portfolios by cutting through market weakness. Today, we are putting Dominion Energy under the microscope. They've laid out a massive new blueprint for the future, a $65 billion bet. And we're here to determine if it's built on solid bedrock or, well, shifting sand.
That's right. We're going to stress test the numbers, we're going to stress test the narrative, and we're going to see if this company is a pillar for your portfolio or if it's a liability just waiting to crumble.
Okay, let's start with that headline number, $65 billion. That is their new 5-year capital plan. And I want you to just let that sink in for a moment. This isn't about routine maintenance. It's not a fresh coat of paint on an old asset. No, this is a foundational rebuild of their entire growth strategy. You know, a number this big isn't just a budget line item. It is a full-throated declaration of intent, an intent that could either launch this company into a whole new stratosphere or weigh it down with debt and broken promises for a decade to come. It absolutely demands our scrutiny. Now, to put that in perspective, they've just reinforced their growth strategy by 30%. I mean, think about that jump. They're going from an already huge $50 billion plan up to this new $65 billion target. You know, in the world of regulated utilities, a sector that's really known for its slow, steady, predictable growth, that kind of acceleration is, well, it's almost unheard of. It's an incredibly aggressive forward-leaning posture.
Okay, but the question we have to ask, the one every investor should be asking is, can the structure they've built actually handle that kind of load? A 30% increase in ambition looks great on a slide, sure, but can the balance sheet, can the project managers, can the whole system handle that kind of strain? Or are they just overloading the entire thing?
All right, so to determine if this whole build is solid, we're running it through our Iron Financial stress test. Here's our inspection plan for today. First, we're going to look at the blueprint itself. That's $65 billion. Then we'll analyze the engine that's supposed to be driving all this expansion. After that, and this is crucial, we'll test the load-bearing financials, we'll probe for any and all stress fractures, and then finally, we'll deliver our structural integrity report. Let's get into it. Okay, so a bigger number on a slide. We see that all the time. But is this just ambition? Or is there real, tangible, verifiable demand to justify pouring this much concrete? I'm looking at a $65 billion price tag, but what I really need to know is what are they actually building with it? So where is all this capital going? Is it diversified across a bunch of reliable projects, or are they making one massive, highly concentrated bet on a single trend that could blow up in their face? So the capital is diversified across the grid, which from a risk management perspective is something you want to see. You've got 25% going to transmission, another 20% to distribution. That's your core blocking and tackling for a utility. They're also setting aside a pretty significant 18% for new gas generation, which they say is to ensure grid reliability. But, and you have to understand this, make no mistake, the driver for over 90% of this massive increase in spending is singular. It is powerful. And it's all happening in their single largest market, Dominion Energy, Virginia. And it's being driven by the absolutely insatiable appetite of one specific industry. And that right there brings us to the engine room of this entire plan. You see, Virginia isn't just another data center market. It is the largest data center market in the entire world. In fact, it's bigger than the next 5 U.S. markets combined. This is ground zero for the AI and the cloud computing revolution. This is where the really heavy lifting for Dominion's growth is happening, and it is happening at a scale that I think is difficult for most investors to truly wrap their heads around. Take a look at this number. This is the pipeline of demand they see by the end of 2025, 48.5 gigawatts. To give you some context on that, just a year and a half ago, that number was 16.5 gigawatts. That's a nearly 3-fold increase in committed and potential projects. This is not a slow burn, people. This is an explosion of demand. And look at this data point right here. All of the top 20 peak demand days in their entire operational zone have occurred in just the last 14 months. The demand isn't some far-off forecast. It is real, it is massive, and it is here right now. Now, here's what's really interesting about this slide and why it's so powerful. This isn't speculation. That orange line you see, that represents their demand forecast for the next 2 decades. The blue and green bars, those represent legally binding executed contracts that are already on the books. As you can clearly see, the existing contracts they have right now more than cover their entire demand forecast all the way out to 2045. That's the rebar holding this whole structure together. They don't need to go out and sign another major contract to meet these growth projections. They just need to build out what has already been committed to. Okay, let's look a little closer at that rebar, because not all contracts are created equal. You have engineering letters, what they call ELOs, which are basically just paid studies. A tech giant can pay for one of these to see if a location works, but here's the key. They are non-binding.
Then you move up the chain to construction letters, CLOs. Now we're talking. These are a firm commitment to build and, more importantly, to pay for any costs if they decide to cancel. And then at the top, you have the Electric Service Agreement, the ESA, which is the final, rock-solid, binding contract for service. So when they talk about this massive 48-gigawatt pipeline, how much of it is truly firm versus just being a blueprint on paper?
And here's the detail that gives me pause. 43% are firm commitments. Those are signed, sealed, and delivered via the strong contracts, the ESAs or CLOAs. But that means that more than half of that pipeline, over 27 gigawatts, is still in that non-binding engineering study phase. Now that is a potential stress point. A company can pay for a study, and then if market conditions change or they find a better deal somewhere else, they can just walk away. So is that a truly firm foundation for a $65 billion build-out, or is it just a plan drawn in the dirt that could wash away in the next economic downturn? That's the risk.
That's a fair point. The risk of those LOAs converting to firm contracts is real, and it's something we absolutely have to watch. But you have to realize, a bet against that conversion is a bet against the entire AI boom itself. The biggest companies in the world are in a desperate, frantic race for power. So for now, let's move to the load-bearing numbers and see how this all translates to the bottom line. Because ambition is one thing, but execution is everything. Let's start with their 2025 performance. Did they actually deliver on their promises last year?
The answer is yes, they delivered. Across the board, they beat their own targets. Operating earnings per share came in at $3.33, above the midpoint. Their funds from operations to debt ratio, which is a key measure of their ability to pay down debt with the cash they generate, was solid at over 15%. Check. And their parent debt ratio came in comfortably below their 30% ceiling. Check. Crucially, their key Moody's credit metric is now the highest it has been since 2012. So the financial foundation absolutely held up under the pressure of 2025.
And the plan is to build on that strong base. For 2026, they're guiding for over 6% growth in earnings per share. That's strong. They're also reaffirming their long-term target of 5 to 7% annual growth. But here's the part that really signals their confidence. Starting in 2028, they are forecasting a bias toward the upper half of that range, somewhere between 6 and 7%. They're not just expecting to grow, they are telling the market in no uncertain terms that they expect to accelerate.
But, and this is a big but, that growth comes at a cost, and this is where the market gets nervous. Just look at the financing plan. Only 60% of this massive $65 billion build is funded internally from their operating cash flow. That means 40%, a full $26 billion, is coming from external capital markets. That is a huge amount of money they need to raise from outside the company. And it's a mix of debt and hybrids. But more importantly for shareholders, 10% of the entire plan will be funded by issuing new stock. And we all know what that means. That's dilution. And that brings us right to the cracks in the armor. A project this big, this ambitious, it's never without risk. So we need to pressure test these weak points to see if they hold up under the strain of rising interest rates and major construction challenges. And the first, most visible risk is that massive coastal Virginia offshore wind project, or CVOW. It's a flagship project for them for sure, but it's also a major potential point of failure. Right. Now management is confident. They say the project is over 70% complete and it's tracking on budget. But they've also been forced to quantify the risk of a delay. And as you can see from their own words on the earnings call, a delay beyond July 2027 could cost them up to $200 million per quarter in lost earnings. Now that's not our speculation. That's their number. And we already know that winter weather and a human performance error have caused weeks of downtime on turbine installation. Every single day they're not installing is a day the clock is ticking on that contingency budget. Okay, now let's talk about the cost that hits shareholders most directly, 2.5%. That's the average amount of new stock or equity dilution they plan to issue every single year to fund its growth. So while the company's asset base is growing by 10% a year, each individual share you own is getting diluted, your slice of the pie is getting smaller. And it's not a secret. Management themselves admit this dilution directly shaves 2.5% off the earnings growth rate right off the top. It's a guaranteed drag on performance before they even start. So the crucial point is this. It's a classic tug of war. On one side, you have the absolutely incredible tailwind of data center demand, which is real, it's contracted, and it's accelerating. But on the other side, you have these significant headwinds of shareholder dilution, the high cost of financing in today's interest rate environment, and the massive execution risk tied to these huge projects like offshore wind. The entire investment thesis, when you boil it all down, comes down to a single question. Which of these two forces is stronger? Exactly. So let's bring it all together for the final verdict. We've run the stress test, we've examined the blueprints, we've looked at the load-bearing financials, and we've probed all the potential fractures. What's the final structural integrity report on Dominion Energy? Is this a generational opportunity to power the AI revolution, or is it a value trap, just waiting to spring on unsuspecting investors?
Look, the opportunity here is undeniable. Dominion is quite literally building the energy infrastructure for the AI and cloud revolution. The demand is real, it is massive, and as we saw, it is contractually secured for decades to come. That is an incredibly powerful foundation. But the risks are just as tangible. This is a massive construction project, both physically on the ground and financially in the capital markets. Any misstep, any delay, any unexpected rise in costs has a direct and immediate impact on shareholder value. Ultimately, it boils down to this. When you invest in this company today, you're betting on flawless execution. If they can build on time and on budget, the growth engine from these data centers could be absolutely unstoppable, driving earnings for years and years. But any significant delay or cost overrun gets paid for directly by shareholders. It happens either through a higher debt load that pressures the balance sheet or through more equity dilution that waters down your ownership. It's a very high-stakes build, and as an investor, you have to decide if the potential reward justifies that very real construction risk. The final build just isn't in yet.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.